All righty. Good afternoon, everybody. Hope you're well. Welcome to the weekly market talk. Dan Sheridan. We're going to talk about cash secured put alternative. Before we get started, just tell you what's cooking. That way we can just jump right in. A couple things we got going. As you can see here, every Wednesday we've been meeting at 1 o'clock Central. The other thing we started the last couple of weeks, excited about, we have a special price here for $49 for your first month. You can get a taste of our cooking, very practical option teaching we've been doing for 15, 16 years, and our new basic program, which is about 2 to 3 hours of live content a day. I probably put on at least 4 live trades a week, and you learn risk management. So it's teaching risk management, adjustments, and a lot of live trading ideas in different areas, spec, income, kind of an investor approach. All right, jump in and talk about the subject of cash secured put alternative. Let's start out with this question for you. Give me a stock that today, even with the market at pretty high levels, 30.99, we're finally down a little bit today, down 20. But what's a stock that you would buy? What's a stock you like that you would buy 100 shares in that you like for the next 3-4 years? So you're wearing your investor hat. We're not talking about speculation. Where do you think is going to be up or down in the next 2 days? We're not talking about that. We're saying, what's a stock that if you bought 100 shares of today, you're going to keep it for 4 years? Give me some stocks that you like that when you wear your investor hat and you want to be long, Amazon, Microsoft, Visa, Costco, Boeing, UNH, BX, NVIDIA. So BX. So these are stocks when you're wearing your investor hat, you buy 100 shares of and you'll hold it for 10 years. You like it long term. Agree? Dave, MasterCard. Okay, a good list, right? And good list. So a very popular, so let's just take one of these. A couple people actually put down Boeing for long term. So a couple people are looking, hey, I think it'll recover, which it kind of is, but you're looking at Boeing long term. You can see here we've recovered quite a bit. Boeing's trading at 360, almost 369 today, up about $2. So in the options world, popular strategy, which is similar to a covered right, is a cash secured put. How many of you have done that type of a strategy? How many of you have done that type of a strategy, cash secured put? So we're going to go in here in December 20, and we're going to sell one put. And let's talk about this trade. So with Boeing at $369, let's say we went and sold the 345 put. This is the trade, right? So with basically Boeing, this is a Thinkorswim TD Ameritrade graph. We're basically trading at 369. The green line is the expiration graph. Again, I'm selling one Dece 20 345 put. Let's call it 330. That's what we're trading at. This is the expiration graph in 30 days. This purple line is the graph, what it looks like today. And eventually over the next 30 days, the purple line will morph into the green one. And so when I look at this, I'm selling the 345 put. How many points is that underneath the stock price? How many points is that underneath the stock price? I'm not trying to stump you. 224, right? This is 24 points. The short strike we're selling is the 345 puts. So this is a strategy that many people love. Warren Buffett has done it for years. Michael Dell. People, obviously, they like their stocks. So in stocks you like, it's a great mechanism for monthly income. And it's also a great mechanism to buy stock you like at a 5 to 10% discount from the current price. So it's been a popular strategy. And if you see here, if we're selling this put for $3.30, yes, this will be recorded and made available. Yes. If we're selling this for $3.30, we're bringing in $330. And as long as Boeing does not finish under $345, right, in the next 30 days, what happens? What happens if Boeing does not finish under 345 in the next 30 days? We win. And what does we win mean? It means we pocket the entire $330. And that's one time. If I did it 10 times, I'd collect $3,300. And if you notice there next down here, the delta of the 20 put, the 345 put, is about 20. This is a symbol for delta. So if somebody's going to sell the 345 put, would you like to know, is it important to you, if you're going to sell the 345 put, is it important to know the probabilities of Boeing being under there or going through that strike? And as Dave says, with a delta of 20, what does it mean? It means there's only a 20% probability over the next 30 days that we're going to finish under 345, and you can flip that around. We've got an 80% chance of winning. Can it happen? Of course. Of course. So we have this high probability situation where we're selling a put. If Boeing, when you look at that type of move, what percent move in the stock over the next 30 days, what percent move in the stock would it take for Boeing to hit 345? That's about a 6.5%. Thank you, Steve. That's about a 6.5% move for Boeing in 30 days. Not 6.5% over a month or over a year, but over a month, right? So kind of a high probability trade, probably going to collect the income. But we have a mechanism set up that if we do go under 345, we've obligated ourselves to buy Boeing at 345, the strike, minus the premium of 330 would be 341.70, right? So with the stock at 369, we've obligated ourselves to buy it at the short strike of 345 minus our premium of $3.30. Gets you $341.70. That's a nice gain. So you're basically saying, hey, Boeing's here. I'm going to sell this strike, collect the premium, and I like Boeing long term. And if I get assigned on the put, I'll buy the stock, which is $369 now, for $341.70. That's not bad, right? And again, the important thing is, if you like Boeing over the next 2 years, would you do this strategy every month? Yes or no? If you like this, if you like Boeing over the next 2 years, yeah. And if it goes lower, do it again, right? So this is a popular strategy. It gives you monthly income, high probability, good monthly income, and you have a mechanism to buy stock at 5 to 10% lower than the current price. And as a long-term investor, you know, it's a wonderful situation. Do you agree? We got one problem. As they say, Houston, we got a problem. Now let's talk about return on your investment, capital. If you do this in a retirement account at TD Ameritrade or any other brokerage, what are they going to charge you to do this trade roughly? Anybody have any idea? What are they going to charge you to do this trade? Well, I'm not talking about the commissions. Commissions at TD Ameritrade, Dave is right, 65 cents a contract. But how many dollars of capital are you going to have to put up to do this trade to bring in $330 for the next month? The answer is about $34,000. You got to have enough money to buy the stock, but less $3.30. So let's call it, for sake of discussion, $34,000. If you're making $330 divided by $34,000, would everybody agree that's less than 1%? Why is the yield less than 1%? Because it's a naked option, and the brokerage firm is going to charge you commission enough to buy the stock if you're going to sign. So is there a more effective way to do that? And so what I've come up with is a cash secured put alternative, right? How can you collect most of that premium, $3.35, but not put up anywhere near $34,000? And the answer is a wide put credit spread. So let me illustrate. And we're going to take the same short option, the December 20, 345 put, which is now trading around 335, and the stock in Boeing is around 369. So what I'll do, any questions so far on the short put? Any questions on the, and again, cash secured put simply means that you have enough money in your account to buy the stock, right? I mean, a cash secured put and a naked short put are the same, you know, you're selling a put. But a cash secured put implies more responsibility, more dignity, right? You have $34,000 sitting there in your account to buy it. So let's get rid of the put. We're going to use the same put, but now we're going to do a credit spread. So we're going to sell the exact same put. We're going to sell the D20 345 put, but now we just want to buy a hedge and create a defined risk spread. So if I sell the 345 put, and the 345 put is going for, as we said, stock's going down a little bit in that now it's about $3.40, but it's up there. let's say I go out of the money and I buy a put against it, right? Against the 345 put. And let's say I go by let's give an example of one, the 315 put, right? Again, I could have gone a little narrower, but I just want to make a point. So now I've created a spread, and what I've done is the 345 put, I was trading for about $3.40. Now I'm saying, you know what? To cut my capital and get a better yield, I'll give up some of that 340. I'm going to buy a put against it at let's see, 70 at 70, roughly 70 cents, right? So I'm going to give up some of that 340 credit. I'm going to buy a put at 70. So that's going to give me near, that's pretty close, 270 credit. Does everybody understand what I'm doing? All I'm doing is buying a lower put, giving up some of my premium. I'm giving up some of my premium to create a defined risk spread that I won't have to put up 34,000, right? So now what is my margin? What is my risk? Do I have to put up 34,000? No. The difference between my short put and my long put is 30 points. So for every one I do, I have $3,000 of risk, less I'm bringing in a credit of $270, 270. So now instead of having to put up, what, $34,000, now I put up 3,000 minus 270 is $2,730, right? So I'm getting a 270 credit instead of 240, instead of 340, but I'm only putting out a $2,730 outlay per one contract versus 34,000, right? And now my return, my potential return, is $270 divided by 2,730. My return goes from under 1% to almost 10%. You see that? Does everybody see that? So we're having this conversation about this cash secured put alternative, and now we have a strategy that can bring almost 10%. How many of you see that this is a much more efficient way of doing a cash secured put? Much more efficient capital-wise. One caution. Let's say I'm doing this in Boeing, and maybe George is used to doing cash secured put, and she's spending $34,000 to sell one of these 345 puts, and she brings in 330. Well, now she says, wait a second, I can do these put credit spreads. Should Georgia take the 34,000, instead of doing one, she could do 33 contracts or so, or 30, or whatever. Should she do that? Should she leverage it? What do you think? Probably not, right? Probably not, right? Because if the market were to correct here, you're going to get nailed. So I would just do one, right? Just like you're doing. And you say, well, Dan, what do you do with all that extra cash? Would everybody agree that's a good problem, right? And you can work on it. But the point is, I just want to make sure you don't You don't want to leverage the daylights out of this. Now, so in this class starting December 3rd, what are we going to talk about? We're going to talk about this strategy and really dial in on it. Something you can do every month, how to pick the stocks to do, what strike to sell, what strike to buy, what profit target should you look for, when do you get out when it goes against you, how do you adjust it, how do you run a portfolio of these strategies, how can you diversify these strategies, maybe do some in more volatile stocks, do some in less volatile stocks. And so we're going to really dial in on this. I think this is a strategy that you can do every month. Absolutely every month. And so I would invite you, come December 3rd, we should have a sign up on this in the next week, to take this. It'll be a 3-week class. We'll put on quite a few live trades to illustrate this, but we'll be able to give you some practical steps that you can do this yourself. That's the key. And instead of settling for under 1% in covered rights and cash secured puts, we're going to show you with these cash secured put alternatives. And again, I'm not sure if I should, I'm kind of weighing it. I had a course class cash secured put and then one on long diagonals. So long diagonals would be a covered right alternative. Wide put credit spreads would be a cash secured put alternative. I might combine them. I don't know how many of you would like to see them combined or keep this classes separate. It's 3 weeks. We do 2 classes a week, so that's 6 classes. I might combine them just because they're very similar. They're similar strategies, but I think it's important that you guys do something like this and learn about it, because the returns are so much better than cash secured puts and covered rights, and your returns go through the roof. And I think John Schenkel already has a link, and you can click on that. This will be a 3-week class starting December 3rd. It will go Tuesdays and Thursdays at 1 Central. Each class goes about an hour. All classes will be recorded and archived in case you're working. And the great thing that's unique about our classes, they stay archived. You can watch them months after the class. But there's a button on there, Ask Dan a Question. You can always ask questions anytime after the class on the material that we went over. So I want to encourage you. I think that should be a popular class, especially if I combine them. I think I will, combining the covered rights alternative, the long diagonal, kind of a 2-for-1, and the cash secured put alternative, the wide put credit spread. And for those of you who have done covered rights or cash secured puts over the years, you don't want to miss this, because this will be something that'll be a big help to you. So anyways, that's it. If you have any questions, you can email me, dan@sheridanmentoring.com. Also, you can go to the front of our website and check out the stuff on there. And as John Schenkel said, if you do this class, the nice thing is you get the basic for 1 month, which is the basic program, which in addition to the online class, you would get for 1 month 2 or 3 additional hours of teaching from myself and Mark Fenton, the other mentor who works with me. And, we're giving out probably 3 to 5 trade ideas a day. And so I think that's a great bonus. If you sign up for the online class, you get the cash secured put alternative, covered right alternative, the long diagonal cash secured put alternative, the wide put credit spread, and you get 1 month of our basic program thrown in there, which will give you 2 to 3 hours of live trades, adjustments, teachings, and we'll be helping you navigate through the market. That's the key over the next 30 days. And, I'll talk about when I would do this weekly, when I would do this monthly. It'll be different durations. When I would sell the short strike 30 days out, when I would sell it 7 days out, and how I would do that. And I think these are all important things. So anyways, thanks for attending today, everybody. I appreciate it. We'll see you. This is a tremendous package for the $297 for the cost of this double barrel class, the cash secured put alternative, the wide put credit spread, and the covered right alternative, the long diagonal. You get 1 month bonus of the basic package, and which will be 2 to 3 hours of teaching a day, all recorded. And I think you'll really, for those of you who are serious about becoming a good options craftsman, it's a great opportunity. So thanks, everybody. Appreciate it. And we'll see you December 3rd. And that will kick off the class for 3 weeks. And then you'll get from December 3rd to January 3rd, able to experience the great teaching here at Sheridan Mentoring. Thanks, everybody. Appreciate it. So you get the class and bonus for 1 month for $297. Correct. A 3-week class plus the 1 month of 2 to 3 hours of teaching, which would be a lot of live trades, risk management, adjustments, and Sheridan Mentoring for 1 month. Thanks, everybody. Appreciate it.